What's always driven the gold price more than anything else is people's concern about the maintenance of their purchasing power in more conventional savings instruments. And there is nothing that should worry savers more than interest rates which are insufficient to keep pace with inflation. The best illustration of this I know is the U.S. 10-year Treasury, which will pay you 3.4% interest every year for 10 years in U.S. dollars, in a currency which the U.S. Congressional Budget Office says is losing 7% of its purchasing power a year. In other words, the arithmetic is that the U.S. government guarantees to reduce your purchasing power by 3.5% a year, compounded for 10 years. The first promise made by the government that I'm prepared to believe that they will keep in my lifetime.
The current economic situation in the U.S. is worrying. Inflation is rising, the government is printing more money through quantitative easing, and the debt and deficits are ballooning. Investors are concerned about the value of their assets and are looking for places to protect their wealth. This is the reason why gold comes in. During the 2008 financial crisis, gold prices increased significantly as investors sought to protect their wealth. We're seeing a similar trend now, with gold prices already up 15% in the last year. Welcome to another episode of the Economic Diary, and today we'll be hearing a lot from Rick Rule about how the demand for gold will increase drastically. Now let's listen to this.
It's important, too, to consider how far gold can go. The market share of precious metals and precious metals-related securities in the United States, the market I know best, is less than 0.5%, which is to say, precious metals-related investments comprise less than 0.5% of all savings and investment asset classes in the United States. The 4-decade mean market share is 2%. I believe that negative real interest rates, quantitative easing, debt and deficits combined will at least propel gold's market share to the 4-decade mean. If that's correct, demand for precious metals-related assets will increase fourfold, which is precisely what I think is going to happen. I think we need to consider three things there. The first is that traditionally gold bull markets are led by the big companies. And we've seen that happen this time. The move into gold, particularly from generalist investors, has concentrated among the equities and large cap names, which has almost always happened. So the lag in the small cap names relative to the large cap names can be expected. We're just now starting to see a mergers and acquisition cycle, which is usually what kicks off the juniors. It's important to know that this gold bull market is unlike some others in the sense that it's occurring consistently with a lagging market in equities generally, small cap equities generally. So the marginal equities, and there's nothing in the world more marginal than a non-revenue producing gold junior, have suffered disproportionately. I think it's important too to understand that investors need to be much more discriminating among their juniors. There are probably 2,000 mining juniors in the world, and I would suspect that not more than 300 of them are viable. So it's very important that investors use information services like Kitco to segregate among the good, the bad, and the ugly in the mining juniors. Make no mistake, if gold continues higher and the majors continue higher, the juniors will get pulled along. It's happened 4 times before in my career. This follows a predictable pattern. The timing is uncertain, but my suspicion is that the outcome is inevitable. There is nothing like M&A to add both liquidity and hope to the sector, with everybody looking for the next name. The other thing is that the money that the juniors were able to raise 10 years ago and begin to focus on exploration is beginning to bear results. We all expect that when money's raised, we get exploration results in 6 months or 8 months or 10 months. That's not the way it works. It takes a decade of focused exploration on new terrain to begin to yield discoveries. And we're starting to see the beginnings of a discovery cycle. The West African discovery in Burkina Faso, the predictive discovery, the discovery of Chalice in Australia, the wonderful new discovery of Canadian-listed Reunion Gold down in Guyana. We're beginning to see a renaissance, not merely in exploration expenditure, but rather in discovery success. So my suspicion is that the discovery success that we're just starting to see, stirred into the pot with M&A, will be what ignites the junior cycle. You may know banking is near and dear to my heart. I've been part of starting 6 banks in the course of my life, and I'm in the process now of starting a 7th, Battle Bank. So I'm attracted to the banking business. First of all, it's a very good business, but it's a business that's really about blocking and tackling. I am going to argue that the last 40 years, which is to say 1982 to 2002, were probably the most benign economic climate in the history of mankind. Declining real interest rates, a great demographic boom, massive inclusion around the world, great trade. And I think the benign economic climate that we've faced for the last 40 years is over, which means that banking has to change. What happened to the banks that failed is, despite the fact that several of them, including First Republic and Silicon Valley Bank, had very good basic franchises. They served their borrowers in particular well. They forgot the part of banking that goes around blocking and tackling. The idea, as an example, that you would fund long-term 5 or 6 year investments with overnight money is the same liquidity mistake that brought down the United States savings and loan industry in the later part of the 80s and the early part of the 90s. We've seen this before. The idea that you have 5 or 6 year duration assets that you're funding with overnight liabilities is difficult in 2 senses. If the interest rate rises, the interest rate that you're receiving on your assets isn't increasing, but the interest rate that you have to pay on your liabilities does increase, so your lending margin goes away. The second thing that happens is the capitalized value of the distributions, which is to say the price of these longer-term bonds, falls with rising interest rates. So your costs go up, but your assets go down. And the mark-to-market losses that were experienced by First Republic Bank and by Silicon Valley Bank are really the things that caused a run on their deposits. The idea that it is the business of the Fed to manipulate interest rates is bad policy, but good politics. Listen, artificially low interest rates really constitute a war on savers by spenders. In a democracy, spenders are more numerous than savers. So artificially low interest rates, which is to say policies that penalize savers on spenders, penalize savers on behalf of spenders, are always going to be popular. But societies never get rich by spending. They get rich by saving. What should the Fed do? The Fed should get out of the way. What will they do? More of the same. Unfortunately, when I look at the Fed in the United States and I look at the employees of the regulator in various regional centers, I see very highly qualified, very intelligent, very motivated people. At the top of the agency, I see a political agenda that in my country comes out of Congress, in your country comes out of Parliament. Which means that the politicization of interest rates is in itself the problem. My suspicion is that the period of higher interest rates that we have seen will lead to market disruption, as it had, and will eventually lead to economic disruption. When that happens, I suspect that the noise that you will hear from the political class will cause central bank officials in both countries to either moderate the increase in interest rates or lower interest rates. And if that happens, if the amount of interest received by depositors continues to decrease relative to the value of the spending power of their currencies, I think one of the outcomes that you will see will be increasing disintermediation from savings products into gold. A response mechanism that's been tried and succeeded for 2,000 years.
To wrap up, it's evident that the U.S. economy is influenced by various interconnected factors, including inflation, quantitative easing, debts, and deficits. While gold's potential to increase fourfold is a topic of discussion, it's crucial to conduct thorough research and consult with financial experts before making any investment decisions. That concludes our video today. We hope you found this information insightful. Remember to stay informed and make wise financial choices. If you enjoyed this video, please like, share, and subscribe to our channel for more informative content. Stay tuned and bye for now.